Welcome back. We have discussed the new Reserve Bank of India rules and their impact on banks and NBFCs as thoroughly as we could. But as you can see, the stock market, barring banks and NBFCs, is actually up and away. Now, one reason why we've been doing well for the past several weeks is that we have put behind a very good second quarter earnings. Now, how good was the second quarter? I have with me Gautam Duggad of Motilal Oswal Financial Services to tell us just that. They have brought out an excellent report analysing threadbare the growth in sales, EBITDA, margins, earnings, and how the second half may look. Gautam, thank you very much for your time. Well, what are your first opening comments on the second quarter numbers?
Hi, Latha. Thanks for having me. Good morning and belated wishes for Diwali and season.
Thank you. Same to you.
This quarter has actually been very good, Latha. Not just in terms of the aggregate beat that we have seen for our coverage, Nifty, Sensex, whichever way you look at and slice and dice the numbers, but most importantly, the participation has been very broad-based. In fact, this is one of the few quarters, I don't remember when was the last time I've seen that almost all sectors that we track have either beaten expectations or have met expectations, right? So 19 out of 21 sectors that we track have either met or have beaten expectations. Only one or two small sectors which marginally missed the expectations. In terms of absolute growth, we've seen 28% earnings growth for Nifty versus expectation of 21%. And for our broader coverage universe, we have seen around 50% earnings growth versus expectation of 40. There is obviously an element of OMCs which come into picture, but even if you exclude OMCs or exclude financials or exclude commodities, the numbers are far better than expectations. The margin tailwind is visible across the board. Second, we've seen an earnings upgrade for both FY24 and FY25, right? So our earnings estimate for Nifty FY24 EPS has been revised upwards from 986 rupees to close to 996 rupees now. And for FY25, also from around 1130 to 1140 rupees. So this has been a picture perfect earnings, I would say. And we've done segregation also, large cap, mid cap, small caps. All three segments of the market caps have beaten earnings estimate. And essentially what it does is it makes FY25 price to earnings ratio for Nifty looks very reasonable now at about 17.3 times. So that's a snapshot of the earnings led by domestic cyclicals like financials, auto, cements, So the trends have been pretty good there, and we have seen a good margin tailwind as well.
Okay, now this is very important what you say, that with the increasing of your earnings forecast, the price to earnings actually looks reasonable now. At 17.8, we are one standard deviation lower than the long-term average, right?
Absolutely. So 10-year average Nifty P is about 20 times. Right now, if you look at FY25 EPS at about 1140, which is our current estimate, we are trading somewhere close to 17.5. Even if you take 4-5% earnings downgrade, you're still talking about 18 times, which is very, very reasonable. In fact, Nifty has been flat for 2 years. So almost sort of a stealth bear market correction for Nifty.
That's a big takeaway that, we are frequently told, very high PE and Indian markets are overpriced, although the earnings is very good. But this is very important, that price to earnings are actually below their long-term average. Now, let me bring the most newsy part. We've got the new rules from the Reserve Bank. Will this make you change your earnings forecast to some extent? Because one understands the NBFCs, both margins and the quantum of loans can fall. So will there be some changes that you have to make?
Yes, obviously, RBI has been making frequent noises about their discomfort with the sharp growth that we have seen in unsecured retailing. Yesterday, they took the first step. Let us see how many more steps they take. I think corporates will also absorb what has just happened. There will definitely be some impact on the growth rates. It will result in some tinkering of earnings estimates for NBFC specifically. But I think the bigger impact will be seen in the valuation multiples, because some segments of financials, specifically the NBFCs, which are a growth play rather than a valuation play, if the growth gets tinkered a little bit or growth gets moderated a little bit here or there, I think the bigger impact can be felt on valuation multiple rather than just the quant impact of 3% EPS change or a 4% EPS change here or there. I think
Okay.
banks are comfortably placed, especially large cap private sector banks, and of course some of the big PSU banks as well, and which is what I think the early reaction of the market today is also portraying. I think the impact needs to be differentiated. First within sector, then within sector across different bottom-up companies, and company by company you have to look at what kind of impact it can have on cost of funds, what kind of impact it can have on their tier 1 ratios, whether there is a need for capital to be raised, and most importantly, how the market views it. Is it just one step and then we are back to the business? Or this is first of the many steps that can follow, because RBI waited for the festive season to get over before
Yes.
sort of taking the step. Second,
Yeah.
they could
No,
have taken the step also on the policy statement, but they
yes.
didn't wait for that. So clearly the discomfort has been there. We need
Yeah.
to wait and watch and see how market absorb this in terms of the valuation multiple for some of the high-priced stocks.
No, I take your point. The warning came during the monetary policy, and the action has come just probably a week after Diwali or a few days after Diwali. So clearly, intent was there. They only didn't want to spoil the fun of Diwali, perhaps. Now, to come back to your earnings, time permitting, I'll come back again to this macro issue of whether it is only banks and NBFCs we have to concentrate, or whether there will be a general consumption slowdown and there is an overall, earnings or valuation impact. But first, in your earnings analysis, have the mid caps done better than the large caps?
I think, Latha, in terms of expectations, both have marginally beaten our expectations. Now, mid caps, obviously, the base was very low. So, in terms of the percentage growth, that looks very different. The magnitude of the percentage growth in mid cap is very high. But I would compare everything against what was in the price, what was expected, right? Versus expectations, large cap have also beaten. Versus expectations, mid cap have also beaten. The other important aspect that you need to remember is mid caps have rallied about 25 to 30% in calendar year 30. Their valuations are trading at a premium to Nifty and also at a premium to their own long period averages. So mid caps beating expectations marginally is well into the price already. It's already factored in. Of course, there are going to be companies on a bottom-up basis where you can still debate whether it's in the price or not. But broadly, from a very top-down perspective, mid caps have rallied well. Their valuations are at a premium. What is baffling is that large caps are trading very, very cheap compared to mid cap right now. In fact, I will go one step forward and say Nifty is looking very, very reasonably priced at this price to earnings multiple. And we are still talking about 20% growth full year FY24. This is coming on a high base. FY20 to FY23, Nifty earnings have compounded 23%. On that, we are talking about a 21% earnings growth for FY24. Some of the other macro parameters have also eased off. Crude is back in that 80 kind of a range from 95. Bond yields, both globally as well as US, globally as well as in India, have come off about 20-30 basis points. So a lot of the macro factors are easing. Earnings growth has been good and valuations are in your favor. And plus, we are entering that customary 6 months period before the election announcement results for the Lok Sabha. And we've done a detailed discussion with Surabhi on her inaugural show of Markets Cafe a few months back, where we discussed that every Lok Sabha election for last 25 years, 5 Lok Sabha elections, the markets have given positive returns 6 months into the announcement of the poll results in May 24. So history is in favor of a good pre-election market rally. Let us see whether it pans out this time or this time is different.
Oh, yeah, and we are getting some help from crude going to $77 and US yields also after a scare, now perhaps moving below the 4.5% mark. So, aapke muh mein ghee shakkar on that note. Now, let me come back to the rule that the Reserve Bank has brought in. Do you worry that you may have to bring down some of the earnings forecasts? Because among your very good mid-cap performers, you also have M&M Financial, Credit Access and Angel One. Now, we know that there is a huge amount of volumes in equities, in derivatives, and some of it could be because of loans from NBFCs, if not from banks and NBFCs. So would you want to rethink any of your earnings as well consumption? I think among your overweight sectors is also consumption. Now with cheap loans becoming less cheap, Do both these sectors, do you think some earnings jugglery, earnings reduction or valuation reduction will have to come?
See, financials definitely, Lata, depending on how every company is placed, which segments they are in, and how do they navigate this latest change in capital risk weights. We'll have to see and basically wait for some time to relax as to how companies change their strategies segment by segment. As far as consumption is concerned, you pointed out very rightly that we are overweight and we are significantly overweight on discretionary. And we have just one staple stock. So if I remember, out of the 8 model portfolio stocks belonging to consumption that we have, 7 are discretionary stocks. Now, this particular step, I don't think it is going to have much of an impact on companies that we have in our model portfolio. For example, Titan, Indian Hotels, Metro, Zomato, Demand, Lemon Tree, Kajaria. I don't think any of those companies get directly impacted by what RBI has done. So I'm quite comfortable owning those names. In fact, if there is any correction in those names, given the growth that is there, the underlying story that is there in those segments, I would be more than happy to buy them if there is any correction. As far as the midcap financials that I spoke about, Angel, we've recently added a month and a half back during the preview when we revised our model portfolio. We had added Angel back at 1900. That point of time, the earnings was about 14 times. In 1.5 months, the stock is up 55%. So obviously the valuation multiples have got re-rated. It is now trading at 21 times. But to remember that the equity volumes have been very robust. More importantly, Angel has been gaining market share month on month. So we are still very comfortable owning those names because the ROEs, payout, the underlying growth, market share, all those operational metrics are still very comfortable in that particular name. As far as other NBFCs are concerned, I think it's too early to take a view because we have to see how companies actually change their gears on growth. Definitely there will be some pullback there. Definitely there will be some earnings changes that will happen as we move forward 1 month, 2 months into this announcement. But let's wait and see how it pans out.
Okay. I take your point. This is the most interesting conversation. And the big takeaway that we have from Gautam is that after hearing that valuations are expensive in India, we hear some very solid arguments that actually things are reasonably priced because earnings have caught up, as Gautam has proven. Yes, speaking about hotels, you had Indian Hotels and Lemon Tree in your list. I can tell you, Gautam, I thought that with G20 over, the big business for hotels is perhaps tapering. And now you realize that the World Cup has actually given them much more business. I can tell you it is very difficult to find even a modestly or reasonably priced hotel room in Ahmedabad today. I know because son and husband have been fighting for it. Yes.
Actually, in hotels, Latha, it is not just event-driven plays, Obviously, G20, World Cup, all of this haven't helped. But the most important underlying parameter which is helping the hotel sector is that the supply growth is very feeble right now. Okay. Demand is growing at about 7-8%, while your supply is growing at 2-3%. And also remember that hotel has gone through an 11-year period of a downturn. And we discussed this in the past. There are 4 or 5 sectors. There have been elongated periods of downturn. And now all of those 4 or 5 sectors, auto, industrials, real estate, hotels, they are going to go upturn together for last 2-3 years. Possibly it may last another couple of years.
Got it. No, your buys and your upgrades are all running even as you speak. So thank you very much for that, Gautam. We have also one eye on the weekend and the hotel rooms that we have to book in Ahmedabad. That's the only reason why I brought it in. Thank you very much for being with us on Bazaar. We have to go into a break and Chartbusters will come up next.